Hi, this is Daniel, and you're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. I'm looking for potential multi-baggers, types of stocks that could potentially go up hundreds or even thousands of percent over time. Now, I personally think that some Chinese stocks represent compelling valuations, and I'll talk more about that later on. Regular viewers know that I've talked about Alibaba and have done a deep dive into their valuation and why I think Alibaba's valuation is compelling as well as its business model. In my last video talking about China and Chinese equities broadly, I talked about Cathie Wood and the ARK funds and why broadly institutional investors were considering dumping their stakes in Chinese equities. And you had seen that with Cathie Wood's ARK funds, where each day they were just plowing away, selling it, even selling it in days where the Chinese equities were dropping, collapsing 5, 10, 20% in just a short amount of time, in just hours and days. And so here, and keep in mind, they were selling it with the ARK funds, they were selling it at prices well below what they had paid for just weeks and months prior. And so in that video, I talked about the regulatory shakedown that had happened within China that had caused a lot of global investors to lose their nerve, sort of saying, hey, why is this? Does this materially impact the investments I own or consider? And that's what a lot of people are asking themselves. Has the game completely changed? Then, recently, in the last few days, Ray Dalio, who's long been a proponent for China in terms of their capital markets growing over time and being a source of significant opportunity, he penned a piece, posted in LinkedIn. I'll drop a link for it below this video, where he effectively was trying to provide a calming word, and I suspect he's also been a buyer in this dip. He didn't publicly, call out any equity, so he hasn't said that, but I will show later on how Alibaba is at least one of his top positions with Bridgewater, at least for their publicly disclosed portfolio. So that is something worth considering and understanding. In this video, I'm going to break down sort of a summary of Ray Dalio's key points, how he sort of looks at the current setup, and also, while I suspect he is a buyer or could potentially be a buyer, at the very least is a holder of his large Chinese equity positions, I suspect he also does have some concerns that he calls out, potentially really two, and I'll talk about those a little bit later in this video, that could cause short-term pressures or effectively more pain. And that's the basis of this video, is could you see significantly more pain in your Chinese stocks in the weeks or months ahead? And this video is intended to do a recap of Ray Dalio's thoughts, his calming words, the opportunity, as well as understanding what are the key risks. Let's dive right in. So as we understand it, in my prior video, once again, institutions are dumping these Chinese equities like Alibaba's stock, and not surprising, you see it collapse, 10, 20, 30%. It's down something like 40% from its high just a few months ago. And so here's Ray Dalio's piece called Understanding China's Recent Moves in Its Capital Markets. I personally suspect he's buying, but let's do a quick summary of his key points. Where first, before you even listen to him, one should understand he's been going to China for 36 years. So he does have some street cred, seeing the development in China, what to expect, and he probably knows the leaders and has talked to them, building strong relationships over time. So the first point I want to call out, and this is very similar to one that I called out in a prior video, is he talks about how it's a state capitalist system. China is a state capitalist system, which means that the state runs capitalism to serve the interests of most people, and that policymakers won't let the sensitivities of those in the capital markets and rich capitalists stand in the way of doing what they believe is best for the most people of the country. Rather, those in the capital markets and the capitalists have to understand their subordinate places in the system, or they will suffer the consequences of their mistakes. I came up with very similar view prior to this. You can check the last video where I effectively said, look, instead of talking about being subordinate, I talked about it effectively looking from the other direction, which is that these businesses need to look at the CCP as their senior customer. And that's what he's saying here. These businesses, they're subordinate to the CCP. They need to make sure you please that senior customer, and then you have a right to do business. That's largely what this resonates with what I called out previously. And the businesses that do not respect the wishes of the CCP, they're the ones that are going to be in trouble. And so that was the mistake that Didi made by going public when the CCP warned them that they shouldn't, that they're still trying to figure out how Chinese companies should, effectively broach going public going forward. Should it be on the Hong Kong exchange? Should it be on the US exchanges? And this was the same mistake that education tech investors made, as the CCP has called out their concerns over rising childcare costs several times over the last few months. These are both things that I've called out in recent videos. So this is an example: disrespect your senior customer and you're going to have consequences for your business model. The second common misperception that he calls out is that most foreign investors who do not have direct contact with policymakers and don't follow in detail the patterns of changes have tended to not believe that the Chinese Communist Party's usage of capital markets to foster development is real. Communist Party leaders showing, the concern is that the Communist Party leaders are now showing their true anti-capitalist stripes, even though the trend over the last 40 years has clearly been so strong toward developing a market economy with capital markets, with entrepreneurs and capitalists becoming rich. And he's effectively saying, as a result, because people have their head in the sand, they will probably continue to miss out. They're probably just going to say, hey, China's just going to steal, the CCP is going to steal the business from the existing shareholders. And he's effectively saying, wait a second, you need to look at this over a multi-decade trend, and that they are effectively pushing market forces that will develop, drive Chinese economic development will likely continue. The challenge ultimately is that these are rapidly developing capital markets. These are rapidly developing sectors and institutions. And so it's challenging to sort of adopt to say, oh man, here are these private education tutoring costs are skyrocketing. We need to address this before it becomes an even greater problem, especially if the party's mandate was saying, hey, we want to actually lower the hurdles to make it easier for people to have more babies. And here's a key point that I think a lot of investors sort of lose sight of, is that China actually isn't alone in terms of massive amount of manipulation. And he talks about how some skeptical investors looked at these moves, talking about by the CCP, and he's in reference, if you read earlier, talking about how they opened up the currency band in 2015 to 2016, and they also effectively burst the Chinese investor retail bubble previously, and how skeptical investors looked at these moves as inappropriate anti-free market interventions, even though these same moves happen many times in many capitalist markets, and even though the fiscal and monetary policy interventions in the US and other developed markets dwarf the Chinese government interventions in its markets. I think he's totally right on this. I mean, let's look at this for a second. The US Federal Reserve right now is printing $120 billion a month in quantitative easing when the economy is red hot. You have 5% inflation. You have a red hot housing market. Of that 120 billion, something like 40 billion is to buy mortgage-backed securities. This is a perfect example of US is dramatically overstepping. That 120 billion, the way to think about that is roughly 6 to 7% of GDP, US GDP, that's being influenced, effectively by the Federal Reserve. Then you factor in significant, stimulus and deficit spending. Now you're talking about somewhere between 10 and 20% of the economy being strongly influenced. And then you could start getting into regulatory influence, like under housing and medicine and education, and how the U.S. does have significant regulatory hurdles there as well. Some argue, as Mark Andreessen has called out, that it might even be sort of sapping the growth rate of U.S. economy by so significantly regulating the medical sector, housing, and education. But I'll save that for a whole separate other video if folks are interested. I found it to be extremely interesting, Mark Andreessen's take. But, as you look at this, you recognize, China isn't alone. The U.S. is a huge manipulator as well. You just need to understand sort of what the game is and what are the rules, what's out of bounds, what are they considering, what's their long-term mandate. And at this point, I really haven't seen anything where the CCP is saying, yes, we are not going to accept, capitalist, effectively forces, market forces driving our economy going forward. It's not like they're taking a step back and saying, oh yeah, communism is the way to go. They see that these huge behemoth companies, these cash cows, these hyper-growth businesses, they've led the way in this dramatic revolution in their economy. I don't think they're looking to kill these golden geese. So, the case in point that the China is not alone, and that some of these policies have really dwarfed the recent Chinese government interventions, is just looking at what the U.S. arguably is doing right now, just in terms of sheer size relative to the economy. And, to think about, well, is this just talk, happy talk from Ray Dalio, or is this, should you put it at face value? And the reality is Bridgewater has significant stake in the game. What they're publicly disclosed U.S. equities, keep in mind, they don't have to disclose things that are, let's say their international portfolio. So if they're buying, let's say, Alibaba on the Hong Kong exchange, or if they're buying Chinese equities or Hong Kong stocks, they don't have to share that. They're showing what's traded on the U.S. exchanges. They own their top five publicly, for Bridgewater, their top five public U.S. equity, Alibaba, over 300 million. Now they did trim it by a very small amount, but it's still one of their top positions that's publicly disclosed. They managed a lot more, but this is what's publicly available. So there is real skin in the game. There is real belief that ultimately these companies, Alibaba is a compelling value and will continue to grow in the years ahead. Now, he also did talk about some big risks, two in particular, that could cause some short-term turbulence that I think investors really should be mindful of. Some really big considerations. First, I'm going to do a quick plug, though, before jumping into those key risks, where you're watching, my name is Daniel, you're watching Unrivaled Investing. If you enjoy learning about potential multi-baggers, please make a point of hitting that subscribe button. If you're already a subscriber, I do appreciate that thumbs up. If you want to follow my personal journey, go to unrivaledinvesting.com. First week of the month, I call out my full portfolio. During the month, I call out at least one potential multi-bagger. And each week, I'm looking, I share my thoughts on the market and any sort of updates and weekly activity. So we're also building a dedicated community at unrivaledinvesting.com, a dedicated Discord community. So let's get back into understanding, these big risks, big pressures that Ray Dalio is talking about. And it's really two components, where one is that, he says you need to understand the global geopolitical environment changing leads to some changes. So geopolitics leads to changes. And the two key risks he talks about as he proceeds is really U.S. government responses. And you can see that reflected in the U.S. government's policy shifts, such as a changing its policies about Chinese companies' listings in the United States. Whether that's, it's not clear whether that's future listings or the companies that are currently listed. I suspect this is a risk to both, effectively saying, hey, if you've currently listed in the United States, you must be prepared for contingencies of some sort, such as being kicked off the U.S. exchanges. So that is a legitimate risk that a lot of investors know about, and he's effectively saying, look, you need to consider this. And he also says B, and this is a threat that I didn't put enough thought to previously, is that threats to prohibit American pension funds from investing in China. So you can effectively have the U.S. government say, hey, pension funds, you can't buy Chinese stocks. And well, ultimately, I think that'll actually hurt pension funds more than they'll benefit from a mandate like that. He further goes on, assume such things will happen in the future and invest accordingly. So he's effectively banking that that's going to happen. I mean, those are big developments that I, over time, put a low probability on, and I've been increasing it over time, effectively saying, okay, so you're going to have delisting at some point, and there's a good chance the U.S. sort of applying geopolitical pressure on China is going to say, hey, all of the investors that we can influence, we're not going to allow you to buy, let's say, these Chinese equities. And so this does create the risk of, could you have a situation where you have short-term selling pressure? Effectively, as these companies are delisted, investors just panic and people are just forced to sell. Pension funds can't buy any new positions in, let's say, these Chinese stocks, but particularly the ADRs. And so that in and of itself could mean this goes significantly lower. That could mean significantly more pain in the future. And that's part of the reason why using Interactive Brokers, that's a platform I'm using, I'm personally buying, I have a basket of Chinese stocks. It's about 25% of my portfolio. Alibaba is just one of those components. I actually don't think Alibaba is the best risk reward. I've called out two other plays that I think are more compelling. That's for Unrivaled Investing Journey subscribers. But I'm personally buying the Hong Kong shares just because I think it's less risky than the ADRs, effectively because I effectively think the ADRs will be forced to convert at some point, because that probability of being forced to convert at some point, it looks like it's going higher and higher. And that's effectively what Ray Dalio is saying, like, invest accordingly. Now, could I be wrong about all of this? Could this just turn into a complete disaster and things get worse? Absolutely. Could I be completely wrong about this? But My view as a long-term investor is you sit tight and you judge things one quarter at a time. And the way I look at this basket of Chinese companies is that they're some of the best companies in China. Talking about Alibaba is one of them, and they've been growing significantly over time. I really don't think the CCP is going to significantly derail that, in which case the current valuations are quite cheap. Yes, you could have some turbulence that causes things to go lower if the US says, hey, pension funds, you can't buy Chinese equities, or it says, hey, Chinese equities can no longer list on US markets. I would expect there to be turbulence in that case. I would expect there to be, yeah, more pain potentially. But that's where it's so important. I talk about this regularly on our exclusive Discord group, is you need to be able to separate the difference between price action and fundamentals. And that's so tough for so many investors because they see price go down and then they think, I need to sell too. They think the house is on fire when prices go down. They think there's something wrong as prices go down. And sometimes pricing does tell you that there is something wrong. But that's why you also need to check the fundamentals each quarter. And so that's what I'm doing. I'm slow playing this. I'm not getting all uppity and, I got to get out of here, getting nervous. I'm not bailing out of my positions just because, okay, valuations are going to be lower. No, I'm going to watch these companies. And if they can continue to execute, growing 10, 15, 20% a year, that, in my opinion, is still a potential recipe for a successful investment return over time. That's how at least I'm playing it from my personal journey. I would love to hear your thoughts, your comments, what you're doing for your own personal journey. Whether or not you think, Daniel, you've just gone bananas with 25% of your portfolio in Chinese equities, feel free to leave a comment. Also, if you think Ray Dalio, despite having nearly 40 years analyzing Chinese equities, analyzing Chinese markets, if you think Ray Dalio is just completely nuts, leave that comment below too. I'm trying to understand, and I'll leave a link to Ray Dalio's post if you want to read the details, share any additional thoughts. So yeah, this is my take on it. Love to hear yours. And if you want to hear more about my potential multi-baggers, go to unrivaledinvesting.com. Thanks so much for watching.